Happy Friday out there, folks. This is Darius Dale to present our macro minute for February 11, 2022. Starting with markets, we have stocks down this morning, commodities mixed, crypto down, dollar up, global bond yields down. Big movers, we have copper off 2%, 30-year Treasury bond yields down 5 basis points. On the macro front, yesterday's hot inflation data out of the U.S. economy were incrementally confirming of our view that the Fed will be forced into a multi-quarter state of autopilot with respect to their monetary policy normalization agenda. While the fastest year over year rates in 30 years in places like shelter, in 40 years in headline and core, or ever in certain instances like utilities, all garnered the headlines yesterday, the sequential momentum is what's driving market based expectations of policy tightening and by extension, Fed policy, because the FOMC does not want to surprise markets. So, unpacking the data, headline CPI accelerated to 8% on a seasonally adjusted annualized basis. That's the highest we've seen since November. Food inflation accelerated to 11% on a seasonally adjusted annualized basis. That's the highest we've seen since September. Energy inflation accelerated to 11% on a SAR basis as well. That's the highest we've seen since November. Core CPI accelerated to 7% on a SAR basis. That's the highest we've seen since October. And then lastly, we continue to see inflation pressures broaden, deepen, touch more pockets of the economy. Median CPI accelerated to a 7% on a seasonally adjusted annualized rate of change basis. That's the highest print ever. And this data goes back to 1983. So this is a big deal. The Fed's got to go. Taking it to the chart here, this one chart's making the rounds is the spread between the 2-year Treasury yield and the Fed funds rate, the continuous Fed funds rate. What we're showing here is just trying to help investors contextualize that time series. So we're in the 94th percentile as it relates to the spread, the 150 basis point spread between the 2-year Treasury yield and the Fed funds rate. And so that's a big deal in terms of the signal to the Fed that they're super behind the curve and they need to go now. And more importantly, they got to go. What we've historically seen is whenever we've seen these peaks in the spreads, we've seen a pretty lengthy material policy rate tightening cycle as well. So this is something you definitely want to keep in mind because we're starting to hear talk. Obviously, the ECB is trying to pivot a little bit dovishly relative to what they outlined last week or a couple weeks ago. But the reality is the Fed will not be able to get off this curve, this highway. There will be no off ramps for at least 3 to 4 quarters with respect to their policy normalization agenda. So that has implications for asset markets to the extent we start to see some trending cross asset volatility. Going back to today's probable range setups, overbought signal in the 10-year Boon yield, 2-year Treasury yield, nothing oversold in the global macro risk matrix. S&P 500 that is still neutral VAMs with 5% of downside versus 4.6% of upside. WTI neutral VAMs 8% of downside versus 3% of upside. Bloomberg Dollar Index that's bullish VAMs minus 0.4% of downside versus 1.6% of upside. 10-year Treasury yield bullish VAMs minus 22 basis points of downside versus 9 basis points of upside. Bitcoin still bearish VAMs minus 20% of downside, still at the upper boundary of its probable range. Ethereum 24% of downside, still at the upper boundary of its probable range, also bearish VAMs. And then lastly, gold neutral VAMs still minus 2.5% of downside versus 1.5% of upside. So with that, Darius Dale presenting our macro minute for Friday, February 11, 2022. Best of luck out there and everyone have a wonderful weekend. Who am I betting on in the Super Bowl? People are going to want to know. I got to go with my boys, Joey B, the new face of the NFL. So let's have a fun weekend. Everyone catch you back here on Monday. Cheers.